Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, December 18th. An increasing number of countries joined the headlines with political and economic problems, while the US investors are worrying about the mismatch between the strong US economic data and a too dovish Fed compared to it. So the Fed will decide today and will more likely than not keep the Christmas magic in place. But the expectations for next year become murkier. So in the latest, Canada joined the political gloom of this pre-Christmas after the sudden resignation of its finance minister on Monday this week, started raising questions about Mr. Trudeau's leadership as politicians in Canada try to find ways to deal with the economic slowdown in the country, topped by Donald Trump's tariff threats. Happily for the Bank of Canada, though, inflation in Canada dropped below the 2% policy target for the second time in 3 months, hinting that the Central Bank of Canada could at least remain supportive of the economy when the politicians are not. So, the dollar CAD spiked to the highest level since the pandemic times. The loonie is now oversold versus the US dollar and is retreating very rapidly against the euro since the November peak. Oil prices aren't adding to the sell-off these days, happily, but they are not helping either. As such, while the political problems in Canada opened the way for further weakness for the loonie, price pullbacks in the US CAD and in the Euro CAD could be interesting opportunities to jump on the back of this bullish trend. A bit lower on the world map, Brazil had to intervene yesterday to stop the bleeding of the real because real tanked more than 20% this year to an all-time low level against the US dollar because ballooning debt and deficit are taking a toll on the country's finances, as remember that not everybody can balloon its debt infinitely and make the rest of the world pay for it. This is one of the major differences, if not the major difference, between what we call developed countries and their emerging market peers. Because look, the French National Assembly just adopted this week a stopgap budget bill that's going to help them to avoid a government shutdown in France from January, as the politicians there took a government that just simply wanted to control and reduce the budget deficit. They took it down. Just like this. And yet, the French 10-year yield, though higher on the latest political shenanigans in France, is not alarmingly higher. This means that France could continue to spend and hope to improve its morose economic and growth outlook for the next few years. And speaking of spending, investors in the US have a very different problem, mind you, because the retail sales in the US has again been higher than expected by analysts, again pointed at resilient consumer spending in the US, and again highlighted the needlessness of another rate cut from the Fed this week that the Fed will announce today, no matter what. We know that. And that's not only because the American economy is just good, it's also because, and especially because, the skyrocketing national debt there in the US does not prevent the global investors from joining and buying its debt. So in summary, yes, the ballooning Brazilian debt is perhaps a problem and should be controlled, but the ballooning US debt, on the other hand, is not that much of a problem. It doesn't need to be controlled as long as the rest of the world is happy to finance it and buy that debt. And the Fed will cut the interest rates on top of it. So it's all very much beautiful for the US, or not so much, because investors didn't really like the sight of that stronger than expected retail sales data yesterday, as it still weighed on expectations of juicy rate cuts from the Fed next year, because now some expect that the Fed could cut only twice next year. And some even think that the Federal Reserve's premature and rapid cuts of 2024 will call for a rate hike next year. But I would be very, very surprised to see a big and a meaningful reversal in the Fed's rate cutting plans today. In the worst case scenario, the Fed officials might signal one fewer rate cut on average for next year in the US. because I just simply expect them to stick to the familiar inflation is moving toward our 2% target rhetoric at this meeting, at least paving the way for the Santa rally to unfold for the final weeks of this incredibly stellar year for the US equities. So the S&P 500 and Nasdaq erased gains yesterday as the US 2-year yield shortly spiked to 4.30% level. Broadcom retreated nearly 4%, but after a 38% rally in the previous two sessions, while Nvidia extended gains in the correction territory. Now, if you're asking when it would be a good time to buy a dip in Nvidia, I would say near $120 per share level that matches the 23.6% Fibonacci retracement level on this AI rally, and is still a 7.5% away from yesterday's close near $130 per share. And if you're looking for a meme moment, well, Tesla offers a good one. The stock price gained more than 3.5% yesterday and has doubled in price since Donald Trump's election as the next US president, given that Elon Musk is given the chance to shape the new Trump administration to his taste at least a little bit. And that obviously helps. So the rest of the car makers, however, are struggling in pain, especially in the rest of the world. Honda and Nissan want to begin merger talks now to give Nissan a chance to survive after its failed efforts to restructure the company, while Stellantis in Europe promised to produce new models in Italy. Yes, in Italy. It's going to be quite expensive, but it will make peace with unions and the government there, as Meloni's government also wants to spend €1 billion and even more than that for the sector in 2025. They don't say who will pay the bill though. In Germany, negotiations between Volkswagen and its labor unions go nowhere really. So the STOXX 600 index remains downbeat these days and is about to test the 500 psychological support to the downside, as the Christmas magic is really not operating in Europe this year. The euro-dollar hovers between gains and losses around 30 pips around the 1.05 psychological mark into the Fed decision. The Federal Reserve's decision today will probably give a fresh direction to the euro-dollar, so a sufficiently accommodative statement and dot plot from the Fed could eventually give some support to the euro-dollar, as it has been enough sold over the past few weeks, and help it to recover above the 105 mark. So that's my base case scenario. But if the Fed turns realistically less dovish, both of which is not their thing, they're not realistic and they're not really little or less dovish, well, you could see the US dollar extend its gains and pave the way for a further downside correction in the euro dollar. So if that's the case, the parity bets will rapidly sit on the headlines in the final weeks of this year. Across the channel, well, the figures come in, but they are not very easy to interpret, mind you. Yesterday's jobs data from the UK looks strong, with strong employment, low jobless claims, and nice earnings growth figures. And along with today's inflation print from the UK, will dash the likelihood of another rate cut this week from the Bank of England. But the private sector shed nearly 200,000 jobs this year, which is perfectly in contrast with the public sector data. So it's obviously not good news for the economy and demands some support from the Bank of England, a support that the Bank of England won't provide easily to balance out the UK's government spending plans next year unless the economy weakens due to the tax hikes there before it improves thanks to the government spending. Now, looking at the chart, we are about to see a death cross formation on the GBP US dollar's daily chart, where the 50-day moving average is about to dive below the 200-day moving average, hinting that the sell-off that we see in cable could accelerate and send the pair toward the 1.25 mark on worries that the UK's economy will weaken before it rebounds. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.